But your great mistake is selling a good company and then it doubles, then it triples and quadruples, because you make a lot of mistakes. And so those ones that go up tenfold, I call them the 10 baggers. So some of my mistakes are just saying, oh my God, this stock is too high, and I was wrong. And you had to figure out, what inning am I in this baseball game?
Peter Lynch is one of the most successful and well-known investors of all time. Lynch is the legendary former manager of the Magellan Fund at the major investment brokerage Fidelity. He took over the fund in 1977 at age 33 and ran it for 13 years. His success allowed him to retire in 1990 at age 46. Lynch is also the author of the best-selling investment books One Up on Wall Street, 1989, and Beating the Street, 1994. His investment style has been described as adaptive to the prevailing economic environment at the time, but Lynch always stressed that you should be able to understand what you own. In 1977, Lynch took over the Magellan Fund, a small, aggressive capital appreciation fund created in 1963 that held mostly domestic investments. An investor who put $1,000 into the fund the day Lynch took over would have had $28,000 the day he left. Under his management, the fund returned an average of 29% per year and outperformed the S&P 500 for all but 2 years. Many investors commonly point to Lynch as an example that active management can achieve superior results relative to the benchmark. Here is what Peter Lynch had to say about when to sell a stock.
When you were actively managing money, you presumably were under the same pressures as other fund managers to show performance results.
Right.
Did that incline you to sell too quickly sometimes?
Well, I think my greatest mistakes are, it's funny, in a stock, all you can lose is 100%. I've done that. But your great mistakes is selling a good company and then it doubles, then it triples and quadruples, because you make a lot of mistakes. And so those ones that go up tenfold, I call them the 10 baggers. So some of my mistakes are just saying, oh my God, this stock is too high, and I was wrong. And you had to figure out, what inning am I in this baseball game? I sold Toys R Us way too early. It went up 20-fold after I sold. I did the same thing at Home Depot. Those are probably my two greatest mistakes I ever made.
When should you sell?
Well, you ought to find out why you bought a stock. If you're saying if it's a cyclical company and they're doing poorly and they're doing awful, you wait till things are getting better and they're doing terrific, and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. Because they still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they went around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. You ought to be able to write that down and follow that. That's what I do with the company. And that's your decision. That's how you sell it.
We have a novel element for many investors today in the trust issue.
Yes.
We also have security problems that we didn't traditionally have in America. Have they changed the way you pick and believe in stocks?
No, you still buy a company, and you buy a company to grow. And if it's a textile company or it's an electronics company or software company, you better understand what they do. And if they do well, the stock will do well, no matter what happens to the market. If the Dow Jones today was 1,000 or 500, you would have made a lot of money in McDonald's. You would have made a lot of money in Johnson & Johnson. You would have made a lot of money in Gillette. These companies' earnings have gone up a lot the last 30 years. And if the market was 50,000, you would have lost money in Burlington Industries. I recommended that in 1969. I think it's gone from 34 to 2 with no stock splits, because their earnings have been terrible.
Well, your modesty actually makes an important point, which is people with the best batting averages in the world don't bat 1,000. Yeah. I sometimes get angry mail, particularly during bear markets, saying so-and-so recommended such and such and it went down. Yeah. Well, how often did you come up with a clinker?
Well, this is a funny business. You don't have to be right even 5 times out of 10. If the times you're right, you make a double and triple. It offsets all those times you lose 20 or 30%. So when you buy a stock, you ought to say to yourself, how much can I lose and how much can I make? And you ought to be able to make a lot. Because stocks are risky. I mean, look at how much we lost in AT&T. Look how much we lost in Xerox. These were quality companies. You know, you can lose a lot in a stock. So you ought to say to yourself, how much can I make? Because I want to buy a stock, if I'm right, I'm going to make a double or triple.
Does your own confidence ever get shaken?
Every day I think the market's going to go up. You know? I keep calling a lot in my company, so I keep calling the company.
His greatest mistake was not losing 100% on a stock, but selling a good company that doubles or triples, or even quadruples. He often felt that a company was overvalued even though the company was a good business that fundamentally did well. Lynch sold Toys R Us way too early. The stock went up 20-fold after he sold it, and he did the same with Home Depot. So when should you sell a stock? Lynch says first of all you need to know why you bought the stock. If the stock is a cyclical company or a special situation and they're doing poorly, you wait until things get better and then you sell the stock. But if the company is a growth company, when you sell is a different question. If it is a growing business, you should think about holding it for a 10 to 20 year period and follow that. That's when you sell. But the most important thing again that Lynch mentioned is, you need to know what the business is doing. If the company does well, the stock will eventually do well. Stock prices often follow earnings in the long run. That's it for today's video. I hope you enjoyed it and learned something new. Make sure to like this video and subscribe to Compounding Club because it helps out the channel a lot. Thanks for watching the video and I'm looking forward to speaking again soon.